The S&P 500 index is perhaps the main indicator not only of the US economy but of the global economy as well. And right now something quite interesting is happening with the S&P 500. By interesting, I don't mean how beautifully the market is growing, but rather the opposite. People, do you even realize just how thin a tightrope you're walking right now? From the low on March 30th, the index surged by about 19% in just 32 trading days. That sounds pretty impressive. Well, it's almost like a perfect V-shaped reversal where the market drops sharply and then recovers just as quickly. But there's a small problem with this situation. The problem is that historically such surges usually didn't happen after a light stroll down of, say, 9 or 10%, but after a real beating in the market, right? After those bloody plunges downward. In 2009, the market grew at a similar pace after a crash of 57%, and in 2020, after the COVID drop of about 34%. In 2015, there was a strong rebound after a nearly 19% drop amid the tariff chaos caused by Trump. So usually the logic is as follows. First, the market is dragged down to the basement, investors capitulate, fear goes off the charts, everything looks absolutely terrible, and only then does a strong recovery begin. Now the situation is completely different. The previous drop was, well, about 10%, maybe even less. By historical standards, this is, well, not just not a catastrophe, it's more like the market stubbed its toe on the bedpost, yelped, and a month later was already off to set new all-time highs, as if there had never been any injury at all. And most importantly, the market is behaving as if it had gone through a crisis on the scale of 2009 or 2020. There was never a crisis of that magnitude, not even close. There was no deep capitulation that all the mass media would write about. There was no serious cleansing of the market from companies with inflated capitalizations. There was no real crash after which you could say, yes, the market has burned out all euphoria, instilled fear in investors, and is now starting a new cycle. Instead of that, we got an almost vertical pump based on two things. Either fairy tales or promises, I don't even know. The first fairy tale is that AI will save the world. The second fairy tale is geopolitics, Iran, Ukraine, Taiwan, and much more. Well, somehow it will all just resolve itself. It's very convenient, but unfortunately it's self-deception. The economy is stalling, geopolitics is on fire, interest rates are pressing, the consumer is weakening, the labor market is cooling down, and the debt burden hasn't gone anywhere. And that's not even mentioning the most important thing, the Strait of Hormuz. It could drag down the entire market. Not just the US stock market, but the entire global market, the world economy. But at least we always have the magic word AI. And if you add another new all-time high to that word, IPO SpaceX, IPO OpenAI, IPO Anthropic, well then anything is possible. Investors can be sold a dream at very attractive multiples. There will be huge returns. The problem is that growth is becoming increasingly concentrated. What do I mean by that? It's mainly AI companies, semiconductors, and software that are driving the market. Well, a few major tech giants. So the index looks strong, but inside it, there's more and more of a sense that this isn't a broad, healthy market, but rather a very expensive showcase, behind which half the store is already closed for renovations. That's why the current growth is dangerous, not because the market is simply hitting new highs. A new all-time high by itself is not a short signal. The market can keep going higher and higher for quite a while. The danger lies elsewhere. The speed of growth is completely out of proportion to the depth of the previous decline. The market is recovering as if there had been a real crash before, when in reality it was just a very shallow pullback of about 10%. This creates a very unpleasant asymmetry. There is still some upside potential because euphoria can last longer than common sense. But the risk of a downturn is becoming increasingly toxic because the price is factoring in too much of a perfect future. And let's think about this. If the market has already played out a post-crisis recovery scenario, but in reality the crisis hasn't actually happened, then what exactly is the market buying right now? Is it buying stocks at the bottom? No. Is it buying the fear of investors who no longer believe in anything? No. The market is buying into expectations and the narrative that the whole world, the entire economy, will turn into AI, artificial intelligence. Investors are buying into the belief that AI will make up for everything. Weak macroeconomics, expensive money, geopolitical risks, the weakness of certain sectors, and the declining quality of growth. When it comes down to it, the story is as old as time. Promises of tremendous development and growth, multiplied by investors' greed. Add a little bit of FOMO, sprinkle a short squeeze on top to decorate the chart, and voila. Another new all-time high. But this isn't movement along a multi-lane highway where the entire economy grows. With many of its sectors, it's movement along a very thin tightrope called AI. For such tightrope walkers, the ending is always the same. They fall into the abyss. This growth is like a shot of adrenaline, right into the heart. And it's more likely that what we're witnessing is not a recovery, but some kind of death throes of the market. Yes, it sounds harsh, but it's entirely possible. First, we're told why this time will be different, and then everyone is surprised when it turns out the same as always. Let's take a look at the chart. Here we have monthly candles. I've marked the major drops, starting with the mortgage crisis of 2007 to 2009. Note that we fell 57.4% by March 2009, after which recovery began. The mortgage crisis. Then Standard & Poor's, the agency that forms the S&P 500 index, announced that the U.S. Credit rating was being downgraded from the maximum AAA by one notch to AA+. And as a result, the market fell by 21.7%. This was followed by a tightening of the Federal Reserve's monetary policy, meaning an increase in interest rates. That was back in 2018. The market reacted with a drop of 20.5%. The next very serious drop of 35% was the well-known COVID lockdowns, the global economy shutdown, a sharp recovery due to cash injections from the Federal Reserve, and then another drop. But that was already 2022. On one hand, high inflation and interest rate hikes by the Federal Reserve. On the other hand, Russia's invasion of Ukraine, the resulting global energy crisis in Europe and beyond, and a market drop of 27.5%. Then another period of growth. And here Donald Trump announces that he will launch tariff wars with the entire world. The market reacted with a 17% drop if we're talking about the S&P 500 index. After that, the market grows, then falls by those 10%, or more precisely 9.7%. This is the situation in the Strait of Hormuz, the situation around Israel and Iran, right? So it seemed like a global catastrophe for the world economy. But no, after that, the market recovers sharply, and we see 2 months of very rapid growth. What do we see on the chart if we remove absolutely everything? We see that the growth is continuing. We see the RSI indicator is in the overbought zone but still pointing up, meaning there's no reason to open short positions. Next, let's take a look at the weekly candles. What do we see on the weekly time frame? We see that we had a fairly deep correction. Yes, the RSI didn't enter the oversold zone, but it did drop below the 50 level. And after that, a sharp recovery followed. Again, nothing but green candles. So there is not a single reason to open short positions. The market keeps growing, and it can stay irrational much longer than common sense would suggest. Accordingly, there's no reason to open short positions here either. And finally, let's look at the daily candles. What do we see here? Here we've stretched the chart, and here is our recovery. We can see here that the RSI is still in the overbought zone, but a situation like this is already starting to form here. Look, if we connect the adjacent highs, they are definitely rising. And now let's connect the corresponding RSI highs. They seem to be moving lower. But we can only call this a quality divergence, and it is in fact a divergence when we see a bearish engulfing pattern on the daily candles. But that's not very reliable, because I'll show you a couple of examples right now. Look, right here we had a bearish engulfing pattern. Let's turn off the magnet, it's in the way. And it didn't actually get any downward continuation. Here we also seem to have a bearish engulfing pattern. The correction was minor and the growth continued, but with the formation of a divergence. So in order to open more reliable short positions or talk about a market reversal that has likely already happened, we should still look at the weekly candles. And here, as you can see, there are no bearish engulfing patterns, as well as the monthly candles. Here we have continued growth, so you absolutely shouldn't buy right now, and now I'll explain why. The E-mini futures chart with my indicators, I've introduced them to you many times before. We're interested in the bottom one. Note that on the weekly candles, it's the red line. When it's in this zone, it indicates a very strong oversold condition. Potentially, from this point, the market could reverse upwards, or at least it doesn't have a great chance of continuing a powerful downward move. Right now, notice that this indicator is at its extreme high point, right? So this indicates a very strong overbought condition. This suggests that the market has a low probability of continuing its powerful growth, but has a fairly high probability, according to this indicator and the index price chart, of moving downwards. This is the index itself, but only the E-mini futures traded on the Chicago Mercantile Exchange. And you can trade them on the Quant Fury platform, which, well, is on my t-shirt, in my heart, and on our blue screens. Notice the 12-hour candles, very strong overbought condition. Daily candles, there's no strong overbought condition yet, but it's close, so we could get there. And finally, the most interesting picture is on the monthly time frame. I'll even expand it specifically for you. Look, here are the monthly candles of the index. What do we see here? We can see that the previous highs in this area right here are actually lower than the ones we're seeing now. And if we take the value of the overbought oversold indicator, we can see that its highs, even at lower values of the index's own highs, were actually positioned quite high. And now look, this movement is exhausting itself. This is a typical classic divergence on a monthly scale, but already according to my overbought oversold indicator. And this suggests that as soon as we see a monthly engulfing or engulfing on monthly candles, then with a high probability we will go to work out at least the nearest target of the decline. And this is the area of 5,800 points, 6,100 points. Yes, we talked about this target back in March when the index was declining, but we didn't reach it. We only formed it at that moment. Now the index has grown, but it will go into this area with a huge probability. And if you really want to buy something, then not earlier than from the level of 6,000 points. And most likely we will visit both this pink zone and this orange one and this pink one as well. That is, we will most likely see the index value of 4,000 points. But it's definitely not worth buying right now. This concludes our review. I just want to remind you that I trade on the Quant Fury platform. You can join this platform. Here you don't pay any commissions at all. You can trade stock market instruments, indices, European and American stocks, as well as cryptocurrencies, gold, oil, gas, and many other financial instruments. Subscribe. Goodbye.